Hi, and welcome to the Adulting 101 video series. This is a quick version video, which means it'll be 15 minutes or less. If you got notes to accompany this presentation, you can pause after each slide to write down your thoughts. And if you're working with a group, there were going to be prompts in the lower left-hand corner to discuss, like what is your purpose in learning about adulting skills. Today we're going to be talking about banking, which is part of the personal finance series. So we're going to look at essential questions. What are banks? What are the services and products that you can utilize in banking? And what are the considerations you can put into banking safety? All right, big idea. For you, the bank is a local business where you can store your money safely, right? I think that's how most people think of the bank. It allows you to receive and send money electronically, like from your employer. They can put your paycheck in your bank. For your bank, however, you are an investor. The money you put in that bank is then used by the bank to give out loans to other customers, and then the bank earns interest from those loans. Does that make sense? So the bank is there to provide a service of keeping your money, but they're not really doing it without a benefit to them. All right, some key vocabulary we want to know when we're talking about banks. To deposit is to put money into the bank for future use. To withdraw is to pull money out of the bank for you to use immediately. To invest is to put money into a long-term account, knowing it will be used by another person or company or bank in hopes that you'll earn interest back on it. Interest is the amount of money normally expressed as a percentage that the lender receives from that person that borrowed the money. And the balance is the amount of money that you currently have in your account. So if you are doing this with a group, I would highly recommend pause here, make sure that you unpack those 5 words, make sure you got that down. Okay, we're going to start with the term FDIC insured. Most banks in the United States say right under the name of the bank, FDIC insured, and it says so on their website and at their door. That means that if you have an account at that bank, the Federal Deposit Insurance Corporation will protect it if the bank fails. So hypothetically, if you deposited money into your savings account and that bank loaned it out to someone who couldn't pay it back and it was just a real disaster, the FDIC would pay you back. That normally covers up to $250,000 per bank customer. So what would you do if you had more than that? Maybe you have multiple banks, but up to $250,000 you can expect to get paid back. All right, choosing a bank. A lot of high school students just set up their first bank account with their parent, so you're just at the same bank that your parent used. As an adult, you can choose your own bank, and I thought it might be interesting to know, how do people choose a bank? Number one, most common, is just location, picking some places close to where you live and work in case you have to go in to file and sign some paperwork. Next one, online access, a bank that has a really easy to use website and an app so they can access their accounts. You can take a picture of a check on your phone and upload it there. ATM fees, a bank that has a no-fee ATM at multiple locations where you live could be a priority. Interest rates, if you're hoping to take out a loan from the bank, you might choose one that has a better interest rate on that. Fraud protection, you definitely want a bank that has established protocols in case of identity theft. Like my bank, one time they saw a signature from me. I was buying a house. I'd signed my name 50 times that day, and they're like, one of them doesn't really look like your signature, so we just want to make sure this is you. And I was like, it is me. I was just really tired, but thank you for calling. And then values. Banks support local businesses, they support charities, and they can support issues. And if they agree with the things that you value, that might be a reason to choose a bank as well. Next, we're going to look at what are the services that a bank provides. We're going to look at accounts, debit cards, ATM machines, safe deposit boxes, and loans. So let's start by talking about the kinds of accounts you have. Most adult bank customers fall into 4 categories. We're going to look at all 4. A checking account is the most common, then savings, then a CD, and then an IRA. So let's start with a checking account. A checking account is also known as a current account. That means that's your primary account where you have money going in and coming out all day long. Like every day, your employer puts money in there, and then you take money out and you buy stuff. If you have an ATM or debit card, it's linked to that checking account or current account. It's called a checking account because you might also have paper checks that you can write as a non-cash payment. Paper checks are safer than cash because only the person whose name is on it can deposit it. While we're here, I know this might seem old school, but we're just going to take a minute to talk about what do you do when you write a check. So we're going to start here in this upper corner. This should have your name, your street, city, and state. If you move, you do need to get new checks. You always want to write in ink, so it can't be erased. No erasable ink. None of those gel pens. A lot of times there are erasable gel pens. If you heat them up, the ink goes away. Most checks are valid for 180 days, so you want to put the date on there, and if somebody doesn't cash it after 180 days, then it's not valid anymore. The number in the corner is just for your reference, so you remember which check number it was. This one's numbered 100, the next one will be 101. Here on the pay to the order of, you're going to write in the name of the person or company that you're giving money to. You're going to put the amount in this box over here, and then you're going to write the amount in full words on the line below. That's just to confirm what if your handwriting was messy, either the numerals or the words, then they can check both of them to make sure they match. The memo line is what if you say what it's for. So if I'm paying back my friend because she ordered pizza for me, I'm going to put in $20 here, and right here I'm going to write pizza, for example. Or if you're donating money to a charity, but you specifically want it to be for one particular program, you could say, I want this to go to the food shelf back to school drive specifically, so they know what to put it for. Then you sign your name here. Down here, you're going to find some numbers. This number, this orange one here, is the routing number. That's the number assigned to your bank. So that you have no control over that. It's just the number for your bank. And then this is your specific account. So this is you. This is your bank. All right, so that was checking accounts. Next one, you've got savings accounts. A savings account is a secondary account where you deposit money that you're not intending to use right away. You're going to leave it in there for a while, and it's going to get a low interest rate. It means every year you earn a few cents, a few dollars on that. And you might put it there intentionally so that it's out of sight, out of mind, so you don't spend it. If you do earn interest on that, you will have to report it on your taxes. Honestly, most of us don't make enough money on that to bother reporting it. Some banks will let you divide your savings account into what they call buckets, which are categories that you're saving for. So you could, within your savings account, have a new car bucket and a future travel bucket and a new house bucket and a holiday spending bucket and an emergency fund bucket. And so you can put money into each of those things. So you could be like, I want to set aside $100 every month towards a new car or something like that. Next, we have CDs. A CD is a certificate of deposit, which is basically a long-term savings account. A customer deposits a specific amount of money and agrees to leave it in there for a specific amount of time. Like you might say, I'm going to leave this in there for 10 years or 20 years. And then the bank says, okay, based on how long you're going to leave it in there, we're going to give you this higher interest rate on that money. So for example, when a baby is born, their grandparent might say, I'm going to put $1,000 into a CD for 18 years. And then when you turn 18, you get that money. And the bank says, got it, we're going to give you a 5% interest rate over 18 years. And then that's what they get when they graduate. But you can't have it before 18 years. You have to leave it there the whole time. And the fourth common type is an IRA, an individual retirement account. So that's a long-term savings account that's specifically designated for retirement. So that means you promise, you put money in there, maybe you set up a regular amount once a month, once a year, and you hope to earn interest on it, but you don't take that money out until you turn at least 59, sometimes later. If you withdraw it earlier, like for an emergency, then you probably have to pay a penalty on it. So let's take a look at how the math works on that with interest rates. So interest rates are normally really low, but even a low interest rate can build money because of what we call compound interest. So let's take a look at that example of that grandparent. So if they put in $1,000 in 2020 when a baby is born, at a 5% interest rate, it's going to earn $50 that year. So now in 2021, it's got $1,050 in it. At a 5% interest rate, it's going to earn $52.50 that year. So by 2022, now it's got $1,112.50. By the time that child turns 18, look it's more than doubled. It's $2,406. So that's how interest rates work. Let's talk about a few other things. Online banking. Most banks are set up for online banking. That means that you can log onto the website and manage your account. You can see your balance, see how much money you have. You can transfer money from your savings to your checking. You can take a photo of a check and upload it, things like that. Electronic payments. Most companies now have it set up that you can pay your bill electronically rather than using paper checks. Your employer can set up an electronic paycheck so that the money is sent electronically from their bank to your bank. You can set up electronic payments from your bank to the gas company or from your bank to the electric company or to the credit card company. It's kind of like Venmo, but for official payments rather than just trading money with your friends or family. Okay, bouncing a check. One of the reasons that some people prefer paper checks is they want to make sure they're aware of how much money they have going in and out. So, for example, if I set up an electronic payment to just automatically pay my bill for a credit card, but I only have $500 in my account and that credit card bill is $600, that's not going to go through. And that's called bouncing a check. It means you didn't have enough money to make the payment, and so the bank bounced it back and said, nope, we cannot give you that money. What happens is that the bank charges you a fee, about $20 each, and the credit card company is going to lower your credit score as well. So you don't want that to happen. A lot of people talk about balancing their account. That means that on a regular basis, you want to just check your bank account and make sure that everything that you thought was going out is going out, and everything you thought was coming in is coming in. Most adults do that on payday, like twice a month. But most bills are due once a month, if that helps you figure out when you want to do it. Debit cards. When you set up your first account at a bank, they're likely to give you both paper checks and a debit card. A debit card looks like a credit card, but it's linked directly to your bank account, and you can use that to pay, like to pay for your gas, to get money from the ATM machine. It helps you get organized and be responsible, but it's not actually earning credit. And you can also get a safe deposit box at the bank. That is a physical box or drawer in the bank's vault where you can put valuable items. Some people put cash, jewelry, their will, things like that in there. There's normally a small annual fee, like $25 a year or something like that. You'll get 2 keys, one for you and one for the bank, to make sure you can't open it accidentally. You can also take out a loan from a bank. That means that they lend you money for a purchase and then you pay them back a little bit each month, including interest. So, for example, if you need to buy a car for $5,000, you could get a loan for $5,000 from the bank with a 5% interest rate, and then you pay them back $100 each month until it's all paid off. A few other questions that people often have about banking. If you're in a relationship, do you want to have a separate account or a joint account? When you're a teenager, you probably have a joint account with your parent, but at some point you want to switch it over to just being yours. If you are in a committed relationship, you might have a joint account with a partner. That means they can put money in your account, but it also means they can pull things out. So that's something you want to think through. Fraudulent checks. When you balance your checkbook, you want to just double check that each of those payments was something that you actually paid for. If you see something that you didn't approve, call your bank right away, and they should implement their fraud protection plan to get you that money back. If you're going to be traveling out of the country, you might want to call your bank and let them know, your credit card company as well. That might be good. Otherwise, they might flag, if you're using your debit card in France and you don't live in France, then they might flag that as fraud. So you want to make sure you tell them in advance. And another question that students have asked is, what about robbery? Thanks to modern technology, bank robbery is very uncommon in movies, but not very common in real life. But just in case someone were to rob your bank, you probably wouldn't even know about it because the bank carries insurance to recover any money that gets stolen. All right, so as we wrap up, I want you to talk about what are 3 ideas you want to take away from our lesson on banking today, 3 ideas that you learned. And if you like this, you thought it was helpful, here are other topics that are available. This is part of that personal finance collection. You can see what other topics are there, if that would be helpful. All right,